Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Bit of a quiet morning, and then we had the Fed announcement, and yields traded up above 3% very briefly, and then right back down south of 3% again. So right now we're still struggling to get to that 3% level, despite the fact that the Fed raised 25 basis points, despite the fact that they see the economy moving along at a more rapid, stronger pace, with the idea that they're going to raise rates more aggressively. In the second half of 2018, we were still unable to get the back end of the curve to sell off, and that's very key here, and we'll talk about that in a sec. But ultimately, we're still stuck in that range. We've kind of went from that 280 to 290 range, but 290 to 3%, but really we need to get north of 310 to see any real change in 10-year note outlook. If we get back south of 280, it means that things are kind of falling apart, and if we want to see things go as the Fed wants, I think 10-year yields need to creep up higher, and they did that slightly, but we're unable to sustain it. Again, we could see that we could see the market sell off again at the end of the week, but ultimately the first knee-jerk reaction was not one that we would say broke us out of any kind of range or took us out of any kind of trade. Right now we are still stuck right in the middle of it, basically where we were when we started the week. And if you look at market volatility, hence we did not break out of the range. We did not see a sustainable trade outside of key levels. Volatility was lower. We did see a modest bid heading into the Fed, which is expected on a key event, but we did not see it sustained. And so if market volatility continues to decline, we're not near those scary levels we saw about a month ago, but we are certainly trending that way if things stay the course. And right now, volatility lower, market holds within the range. Now, we did have a Fed announcement today, and they did talk about raising rates more aggressively, not only in 2018 and 2019, which really saw the short end yields kind of goose up a little bit. We did not see that same trade in the back end. So the yield curve, 2s10s, continued to flatten. Actually got as flat as it's been since September of 2007, and we broke below the 40 level, which is only significant because we haven't traded there since 2007. So I think right now the yield curve becomes a concern because as short-term rates go higher, the back end of the curve needs to follow. And if it doesn't, it kind of creates this uncertainty, this sort of chaos in the market. Is why would you look to buy a 2-year or buy a 10-year when you can get the same or near same return for a 2-year and not hold your money that long? And that is what we're seeing, that conundrum when we see the yield curve get flatter, especially when you see the economy getting stronger, especially when you hear Fed chairmen talking directly about the economy and talking directly about raising rates and talking directly about inflation and employment, but the back end of the curve just hasn't really heard his words, or at least is ignoring them. And so right now the yield curve continues to flatten. When you look at 5s30s, when you look at 2s10s, that in itself will become a problem at some point, but it isn't quite the problem yet today, but we're going to be keeping an eye on it. So right now 10-year note yields still struggling to get above 3%, volatility lower, and the yield curve continues to flatten post-Fed. This is Todd Colvin coming to you from the floor of the CME Group.